Brilliant. Hi, good afternoon, everyone who's currently jumped on. I think we've got a few names now just loading in, so I'm just going to give it 2 minutes. I can see the sort of the number of attendees ramping up pretty quickly, so we'll just make sure that we've got the majority of people in, and then I'll get started with the presentation itself. As a bit of an introduction to what the purpose of today's webinar really is about, very much just to give a lot of our existing investors, potential investors, people looking into the property market at the moment, I guess our sort of viewpoints of where property has been as an investment metric and where we think it's going to go. So we can start trying to have a look into what we think 2025 is going to be like as a year, and then take it from there. So I think that looks about right. So we'll get started with the presentation now. So quick introduction to those of you who haven't worked with GetGround previously. I know there's a number of names on here that I'm certainly have seen it for the first time. So at GetGround, who we are. So we are really, I guess we're trying to push ourselves as the forefront of property investment in the UK, in a means of trying to make the UK property market a fair, well-run, actually slightly more regulated industry within the property investment space within the country. We've been around for a while now. We have actually dealt with well over £1.2 billion worth of transacted UK property. We've got over 30,000 plus active customers and over 80,000 property investors that are dealing with us pretty consistently. With our network, we have a network within this space spanning across the world. Over 1,400 partners. I think we're actually pushing almost to 1,500 partners now worldwide that we're dealing with, different lenders, mortgage brokers, different agents, accountants, specialists, solicitors, really with that mindset with ourselves as a business to create this really strong all-in-one investment space that we can take any investor in the market, and we can provide them with a solution that deals with every single aspect of actually buying and investing in the UK property space. And we have our offices now. We have our office in central London, where I'm based at the moment. Our offices in Hong Kong, Dubai, and Singapore. So a really big remit across the world. And as you'll see there, we're a recognised supplier with the NRLA. And yeah, we've got a pretty good Trustpilot score. So if anyone's interested in looking a bit more into that, please feel free. And you should hopefully see some good stuff about what we're doing here. So to really get started, I think, 2024 as a year was certainly an interesting one. I think for us, particularly being really within the market, and I think a lot of our investors as well, we've seen some really strong aspects, and we've seen some, I guess, some adversity in the market, to put it bluntly. I think some of the real key things we've seen initially is a really big push in initiatives to help really grow and revive the market and really keep the UK property market on this upward trajectory that we've been seeing for the last, 15, 20 years, really, in terms of the UK property market. The government initiatives, this is a mixture of things like the HS2 rail lines to Birmingham, really starting to take shape now. We've seen a lot of government-backed investments across regions like Manchester, Birmingham, really strong private investment as well from very large organisations across these markets also. So really strong amounts of funds still being pumped into the market within the UK, which is just an ever-growing cycle then of really helping to push and extend and develop and grow the UK property scene. On that note as well, there's a really big push now to start trying to get ourselves to a position of hitting these sorts of deadlines that we need to see with UK property and UK development. Still being behind, again, another year in a cycle of the last, I think it's 15 years now, that the UK government hasn't actually hit the target of number of properties that have been developed, which again has just stimulated even further growth in the market, and the supply certainly is not keeping up with the demand as we see it. We've seen a real growth in build-to-rent developments, and I think this has really been a really key factor for markets outside of the norm. London, Bath, Cambridge, Oxford, these kind of areas where typically you've seen really strong quality of historic property. What we're now seeing is markets that actually haven't had that much money spent on them over the years. The quality of property being quite low in the past, which has really spurred on this really big position for better quality, newer investments, newer developments around the country that have to conform to a lot of regulation that we've seen coming in regarding things like ESW1 regulation, EPC regulations, and even further, as we're seeing over the years, that's going to become even more of a factor. A really strong focus on green investment. On that sort of note, EPC ratings, energy efficiency within property is becoming more and more of a thing. It's becoming something we need to be very aware of, particularly when we're looking at sourcing the best investments and making our decisions with what sort of properties we should buy. The resilience. Although we've seen quite a lot of economic uncertainties, the UK residential property market, it has shown that resilience. We've still seen consistent growth. And I think anyone who's bought a property over the last 2-3 years could probably attest to the fact that we have seen a lot of volatility with things like rates in the market and even with like completions and timelines on these certain things. What we've consistently seen, however, is demand and transactions. So although these things have been going on, we're still seeing record-breaking months in the industry of people buying property. And that sort of brings us on to that next point, which is that really strong rental market, increased yields, strong rental markets. What we've seen is with the high rising interest rates, it's discouraged an element of home ownership and actually increased that rental demand in 2024. That high tenant demand has led to rising rental yields. I think anyone living in any market, walking past any kind of estate agent on a local high street has probably seen on, not so much a monthly, but probably like almost bi-monthly to a quarterly basis, rents in local markets increasing very consistently. So again, a really strong factor for investment. Anyone looking to secure an investment with a really strong, steady flow of rental income, and that increase in rents has helped combat that level of increase when it comes to the actual mortgage rates themselves. But that's a bit of an overview there for you first. But I think what we've really seen in 2024. So what do we see moving forward? I think you look at a lot of things from a lot of analysts, a lot of professional analysts in the market. They're still forecasting an average house price increase across the UK of around 3%. Now, this does still factor in markets like London, Bath, these kind of markets that we'd seen a lot of growth in the early 2000s that have relatively plateaued. So actually still seeing an average positive growth across the UK shows how strong the market has been, with particular markets across the country actually showing, we did some studying in markets, for example, an area like Birkenhead, where last year the average growth in the market was about 12.5%. So it's all about getting into the market in the sense that we can see how strong it is in terms of growth, but actually there's still markets out there that are really pushing that and really dragging that growth up across the country. Even further, government incentives. We're seeing even more streamlining of planning processes. There's been a really big positioning for kind of push for things like airport expansions, revitalizing, so the Oxford-Cambridge growth corridor, which again, another really big push there to push that further element of growth and see further demand, triggering more property, trying to keep up then with that demand. But of course, a 20-year setback of hitting targets has certainly left us into a position where we're still very much in a high demand market, even if we hit any particular targets for this year. We look at rental market trends. Rental demand is predicted to remain very strong over 2025, with rental prices expected to grow by around, again, 3% in 2025. There's some signs of certain rental reductions in particular markets. I think it's a positive aspect to see it in certain areas where we're seeing it's kind of reflecting more of a stability play with certain areas. I think particularly when you look at markets like London, where rents have started to get a bit out of control. But what we're still seeing in a lot of other markets is how, we've got markets where rents are averaging 450 to 600 pounds. There's a really big push there for rental growth in those areas because of the demand and the push of outside factors growing, building these markets, making them more suitable for professional tenants, professional people in these areas to help really grow and develop them. And that comes onto that further growth in regeneration areas. We are seeing such a strong level of regen going on in markets like the outskirts of Manchester, Birmingham. We look at some really key factors of a lot of private investment firms working in particular markets. Some of those key ones being these firms working with places like Freeport locations, areas like Liverpool, Hull, Southampton, Leicester, getting these elements of money spent on them because of the increase in business wanting to be based in these areas. So again, it gives us a really good remit to see where should we be looking, how do we target that element of growth, and then how do we actually get ourselves there to really push that and get that element of growth in the background. So going on to this position of potential strategy, and what sort of strategies should we look at? It's probably a bit of a simple one to say, but actually focusing on high growth regions. We can see even places like the Southeast, areas like Berkshire, Kent, West Sussex, East Sussex, Essex, average price growth targeting around 4 to 5%. So it makes it very attractive for capital appreciation, still getting into these kind of home county markets. Areas like, as I said, Manchester, Birmingham, Liverpool, really strong rental demands, major regeneration projects. In a lot of these areas, we're still seeing some relatively affordable entry prices that make them investment hotspots. I think you can look at somewhere like central Manchester now and probably look at an area like central Manchester and be a bit put off by the price that you see on certain things. But that's when we strategize and sit with our investors here and we look at what sort of market should we look at. We're now expanding ourselves out to places like Trafford, Salford, these kind of areas where there's now investment plans very similar to that happened in the city centre, that we can now see that level of growth. If we're talking a 10-minute commute between one property to the next, but a deficit of price of around 100 to 150,000 pounds, we can see a really good target there for capital growth over the next 2, 5 to 10 years, really sort of pushing and growing them. And particular investment corridors. We've got a lot of plans going on with crossrail systems across the north of England, with things like the M4 tech corridor investments. So really good potential in places like Reading, Newbury, these kind of areas that are getting impacted by the regen of the M4 corridor, the Elizabeth line getting put in place. And there's a lot of different things. And I think one of the most important factors within that is looking at what particular market suits a strategy. So just on that note, how we would actually work this with any of our investors is actually sitting down and having a one-to-one investment strategy session. At the end of the webinar, actually, there'll be a link, a QR code that you can scan to, you can book into one if you wish to, where we'll actually sit down and discuss, where an investor is, where do they want to get to, what is the right market to look at, reflecting budget, the return, and more importantly, their goal of where they want to get to. And that's one of the most important things to focus on when we look at investment strategies. Where do we see this getting to in the next 10, 15, 20 years? And that's going to reflect what kind of strategy we want to look at. Of course, this aspect of investing into the build to rent properties, the build to rent developments now, they are booming across a lot of markets because rental demands remain very high. I think we're now seeing that when we see, and this kind of ties into this next point of leveraging green and energy efficient investments, we are moving to a position in the UK where property is becoming more regulated. There are regulations regarding what sort of properties you can get, mortgages tightening up in terms of what they're going to allow you to lend on. So when we look at these high growth areas or these regions to invest into, we have to check for mortgageability, which does then mean we have to check for things like EPC ratings. One of the biggest factors that's caused a boom in newer property over the last couple of years, what a lot of people aren't aware of, is things like the leasehold reform that took place in 2022. Basically, that if you bought a property since the 1st of July 2022, you would be on this new lease structure. And that's only, again, if the property is completed since then or had a new lease since then, which means that your property has to be on something called a peppercorn style ground lease. What that basically means is the abolishment of ground rent. Now, a lot of people aren't aware of that, and they're still going ahead thinking, oh, I need to buy a property in a market that's an older property. And actually, when they're going through the cycle of looking at things, they're realizing that the EPC rating is DEE rated. The lease length is 100 years, 150 years, and the ground rent, they're paying the ground rent, where anyone buying a newer property with a 999-year lease on it, a ground rent, with zero ground rent, so the full ground rent abolished, an energy efficient property which attracts a certain type of tenant who wants to pay a lot less in terms of their bills, but actually makes it more appealing to mortgage lenders having a better quality EPC. The full ESW1 compliance that we see in terms of cladding regulation on buildings. All of these things come together that has kind of now lined the market up that actually newer property in these markets, they do outshine, because we see that in terms of the ability to buy. And then actually when we get onto that side of renting and tenanting these properties and getting professional investors that actually want to live in nicer properties, well-built properties, as opposed to older buildings in these markets that are very much concrete-led, concrete built, and not really up to the standard that a professional tenant would want in one of these particular areas. We've seen a lot of really good opportunities in commercial to residential conversions, whether that is the ability to purchase a commercial or a rundown older building and convert it. Again, with that kind of thing, you would need quite a lot of support within that side to make that effective and make that work. On our end, we're seeing a real big potential for our investors who can then buy into these sites, buy into these projects, very quick turnaround times, get a newer property with all of the benefits as if it was a brand new property, just without the time frame of having to wait for something to complete. And then lastly, the most important strategy I can recommend for anyone is diversifying options, keeping an element of fluidity within your portfolio. If you've only ever invested into one location, whether that's where you're from or where you live, diversifying into other markets. A lot of the conversations I have are investors who have only ever invested in London, for example, and they'll come to me and say, the market's over, the market's dead because I'm not seeing any growth on my properties that I bought years ago in London, without then really looking at the wider position of what property works on a roughly, it's about a 10-year cycle, that you see 10 years of real strong return and then 10 years really of a settling period. Where we're looking at with prime London is we're in a bit of a settling period now. It's kind of plateaued in price. But these other markets now where all of the money's being spent, that's where we're then really seeing that really effective level of growth. And there's been a few things that have happened, again, with things like stamp duty changes. Stamp duty changing the back end of last year, meaning that the surcharge rates went up as a UK investor from 3 to 5%, as an overseas investor from 5 to 7. It's made a really big impact for people looking to buy property, but we're now seeing the majority of investors buying property really like sub 250K. And that's now where we're seeing the real big pushes of growth in these kind of markets. So again, it does kind of shun out markets like London in terms of that accessibility for overseas investors, which again, when we look at growth in the market, growth stems from volume. The more transactions that happen in a market, that's how we see a market grow. So that's the sort of thing we have to really focus on so that we can maximize our returns. And by diversifying, by putting your eggs into different baskets, you can see better chances then to see that capital appreciation and then the ability of getting growth, recycling funds, and certainly buying more investment. So what markets are we seeing, I guess, at the moment that are doing well, or that we can see have got that potential to do well? It's one of the biggest investment regen plans that's gone on over recent years is the Ocean Gateway investment done by an organization called Peel Land and Property. The Ocean Gateway stems across Manchester, Liverpool, as far up to Preston in the northwest. It's been a £50 billion regen across the northwest. It started in 2008 and it's a 50-year plan. We've seen the success of Manchester Waters. We've seen the success of Media City, Salford Quays, and now going into the Trafford Waters plan, where even there we're seeing some really big levels of growth. We're seeing the next wave of that, which is Wirral Waters and Liverpool Waters. So that next key city to get money spent there. We're talking £5.5 billion spent in Liverpool, around £4.5 billion being spent in the Wirral. So as you see on the screen there, that the left-hand side of the River Mersey. So again, really big regeneration plan, low entry points as low as around the £120,000 mark in Birkenhead, over to Liverpool with around sort of the 170, 220 range. So again, accessible routes, and they fit within that remit of where we're seeing the most growth in the market. Manchester still stacks itself up as a very strong investment market. I think the city centre, we're probably seeing a bit of a slowing down within price and price growth there, but particularly getting into these secondary zones around Greater Manchester, that's what we start to see. It's one of the oldest sources of getting a really good investment is focusing on something called the ripple effect that comes out of these city centre markets. We've seen it with London in particular. We're starting to see it with Manchester and Birmingham now, and we're seeing how the pricing now in the outskirt regions is starting to volume up, where the city centres have become relatively unaffordable for some people. That's why people then start getting into those other markets. Investment firms, different developers, different regen specialists, they see that growth and they want to get part of it. So they get on to part of that outskirt region and start really developing and growing. And we can see a lot of plans happening over the next few years. Birmingham, a really big push with the city centre of Birmingham. We're now seeing regions like Digbeth getting a really big push. A lot of the work's there now being done. A lot of developments now coming up to completion. The new tram system closely coming up to completion. The new sign-off of the new sports quarter. So yeah, really big, again, multi-billion-pound investments within these zones that we can see a really big push and a really big potential there. And again, there's markets in Birmingham that are still relatively affordable for investors to get in, particularly if they're first-time or newer investors getting into that. And then lastly, sort of cross-rail zones. Markets where we can see really spanning between Liverpool and Hull. Liverpool and Hull are on two sides of the country, and there's rail systems being developed daily, and we're seeing it really coming into fruition now that we're seeing real good pockets of growth around those markets. Now, when we break that down, property and investment, particularly property as an investment class, isn't like a stock or a share or buying diamonds or gold. It really isn't a one size fits all. Every single person has a slightly different criteria, a slightly different goal, and a slightly different requirement for what they need. So what we would always recommend is, rather than, I guess, standing in front of the map of the UK and throwing a dart and hoping that you pick an investment zone, we sit down, we have a strategy session together, and we work out, okay, what is the best plan? How do we get the best plan together? We work on that, we get the right options together, we build this plan together, and then we get you to that position of actually then buying a property in a market that tailors and fits your options and tailors and fits where you want to be in the next 5, 10, 15 years as part of your investment plan. So I guess that's a bit of an overall spiel about the market, what we think about the market and how things are going. What I'd be quite keen to move on to then is a bit of a Q&A. We've got a bit of time then to sort of sit down and run through some questions and queries that any of you may have at this stage. So I'll just wait for some of the questions to come through now. I should be able to load it up on my screen in a moment, and then we can go through that. So I can see a couple of questions coming in. So I've got one here, which is okay. So this question is with London. If I wanted to invest in London, saying the market has started to slow down, is there any potential to still get into that market and see a return? There are zones. There are particular zones that you can get into. We've seen some great success in regions around like the Greenwich area. We recently had a development in Cockfosters as part of that regen coming out of the city centre that's worked really well. You could probably start looking to push around particular lines on things like the Elizabeth line, pushing outwards towards West London. You can see some real potential out there to get into markets that were pretty untouched in the past, that people are now moving out to because they can get better quality of property, lower rents, which has put a lot of people off living now in central London. I've got another question here, which is, any insight into the Scottish market? Funnily enough, it's something that we probably find ourselves teetering on the idea of how much we want to push within the Scottish market. I think one of the biggest things within the area itself is the rate. There's just a lot more regulation in terms of ability for renting, rental plans behind that. It's just hasn't really come as much of a strong market where we're seeing particular levels of growth and return that we're seeing the ease and the ability to get into the market across really England and Wales as opposed to getting into Scotland. There's small regions that I've seen some pretty good things about. You can get into like the outskirts of places like Edinburgh. There's particular markets within Glasgow that I've personally looked at. But definitely when you're looking for ease of renting and ease of just being able to manage your investments, it still doesn't quite stack up with I guess a lot of markets around England as opposed to Scotland at the moment. But if you wanted to sit and discuss that any further, certainly we can go through that together. Another question here. So thank you for the questions coming through. What are my thoughts on property investments around Kent areas, Maidstone, Chatham, Gillingham area? We actually had a really strong investment that we've got a number of investors that have bought into now, which is recently completed in Kent. I can attest for the fact that I'm a big fan of Kent as a person who grew up in West Kent around the Sevenoaks area. I'm a big fan of Kent, and I've got a lot of family that buy and invest and done a lot around Kent as markets. I think where we looked was Ashford. Ashford in Kent was a really good market, affordable but very well commutable into London. Really good markets pushing outwards across Europe with the international train line. Places like Maidstone, Chatham, and Gillingham, I do think are markets where there's a lot of potential for the future. We've seen a few new regen plans and a few development plans around Chatham, particularly. I think particularly with things like the historic dockyard in the area does make it, it makes it very interesting. I think we're still waiting on the next push. There's been talk about like the new theme park being built in Kent and down towards sort of Sussex as areas, but I guess no real big push on that. I do think there are markets that are worth getting into. Would I say that it's seeing as much growth as like a Liverpool or a Manchester today? No, it's not. But if you're looking for something you could park a bit of money into in the meantime and then see a good potential for growth in, say, 10, 15, 20 years, I do think it's a market worth keeping a good eye on. So just wait for, okay, so I've had another question which has come through here, which was, do we think that the rental increases across the country are still going to carry on, bearing in mind that, I completely appreciate with the question that rents have increased quite a lot in particular markets. It's very much goes back to my point I mentioned earlier about targets, government targets, the amount of properties, the volume of properties actually being built. We're still very undersupplied. I've seen, even speaking to colleagues of mine who are even looking to rent property in London for themselves, speaking to investors, ex-colleagues of mine that deal with like a lot of lettings and management sides, and even us dealing with lettings and management, there's not enough properties out there. It's not so much a case of where we're struggling to find tenants. It's more a case where tenants, I think, are struggling to find the right properties, but then also are getting into positions where they have to actually bid on rentals to actually get a property to live in. So I can't see that rental increases or where rents are at the moment is really going to change until somehow there's a plan in place that means that we build, well, probably about 120,000 extra properties that makes the shortfall up over the last few years that we've seen just to keep up. So yeah, I think population increase compared to property building increase, yeah, there's still a good way to go. So yeah, hopefully that answers your question there. Just so there's no more questions coming through at the moment. So if there's any more questions that anyone has, they want a quick answer to, certainly put it in now, and I can get on to that. Okay, so yeah, just had one come through here. So am I better off looking at a new city centre or a secondary market somewhere? Like, so I'm guessing what you mean there is, yeah, am I worth looking at a Liverpool or looking at, let's say, a Trafford in Manchester? I think the big difference is, again, the ability to get into that market. And a lot of that stems from capital. Trafford as a market is more expensive now than getting into a lot of markets around Liverpool. So where you're still going to see that really good level of growth, the ability of getting from 220 grand to 300 grand to reach that sort of city centre price is still there. Do I think you're going to see as much fast growth as, say, a lower costing location at 120, 130,000 pounds? It's a lot easier for a property to get from 120 to 150 than it is from a property to get from even 220 to 250, just because of that availability in that market and the availability of more people having the access to funds to actually be able to buy in those areas. So I would say you'll probably see a faster growth in the lower costing areas, but you've probably got a bit more of a stable market and a better position for rental yield today in more like the secondary city areas. So yeah, really good question actually, and this probably my last one that I can sort of get to on this. So mortgages on SPVs being pretty difficult. So seeing clients who have bought properties a few years ago, they're trying to sort of work out new terms and yeah, different lenders. I think where we're at in the market today, we have been going through a position with lenders where lenders have restricted certain options. I think definitely it's something that is something in the market that needs to be addressed. Again, that's why we've got our full mortgage team internally. What I'd recommend is either if you've got an account manager here that you're already working with, getting in touch to discuss actually a bit further about the mortgage side, or even book in for a call, and certainly we can look at specifics of particular options within particular investments. There's a lot of factors that's going to come in about who the person buying it is, where they're based, what the structure of their model is that they're buying in, what the property is, where it is, the price of it, the rental demand in the area, a lot of these things. So I definitely say that's probably a very specific question about particular things. Feel free, book in, and we'll be more than happy to sit down and run through that all with you. But yeah, brilliant, guys. Well, I'll end it there. Of course, if anyone wants to jump on and book in for a meeting, use the QR code there. I've actually seen, I can feel my pocket, my phone's buzzing away because people have already booked in, which is great. So yeah, I look forward to speaking to any of you further on our one-to-one chats, and we'll take it from there. Thanks very much.